Imagine you're the CEO of a billion-dollar company. You're sitting in a boardroom surrounded by nervous executives. Sales are slowing, margins are shrinking, investors are restless, and every headline screams the same thing. AI is the future. Your competitors are announcing flashy new partnerships with OpenAI, rolling out AI-powered features, and bragging about transforming the business with artificial intelligence. Analysts are pressuring you with the same question over and over. What's your AI strategy? And so, like countless other executives, you panic. You rush to throw millions of dollars into AI, not because you figured out how it fits your business, but because the alternative feels unthinkable: being left behind. This is the corporate AI gold rush, a frenzy less about solving problems and more about looking like you're part of the future. A theater of innovation designed to impress shareholders and the media, but built on shaky foundations. Because behind the glossy press releases, there's a darker truth. Most of these AI investments won't pay off. In fact, many will fail spectacularly. The FOMO effect. The real driver of this AI frenzy isn't strategy, it's fear. Fear of missing out. Fear of being called irrelevant. Fear of watching your stock price sink while competitors boast about being AI first. That fear pushes companies into reckless spending. They don't ask, does this solve a real problem? Instead, they ask, what will make us look innovative right now? That's why we see banks announcing AI-powered customer service, even though their call centers are still understaffed. Retailers promise personalized shopping powered by AI, while they still struggle with basic inventory management. AI becomes less a solution and more a stage prop, something to polish up investor decks, not a tool to create value. The data dilemma. Here's the dirty secret. Most companies' data, the lifeblood of AI, is a complete mess. Decades of acquisitions, outdated software, redundant databases, and broken processes mean that the information needed to train AI is inconsistent, inaccurate, or just plain missing. Feeding this kind of data into AI doesn't create intelligence, it creates illusions. Executives expect revolutionary insights. What they often get instead are unreliable predictions, misleading patterns, and expensive systems that quietly undermine decision-making. And when the results disappoint, AI gets blamed. But the real problem lies in the foundation, a company that isn't even data ready. The herd mentality. This corporate stampede isn't unique. Business history is littered with herd-driven manias. During the dot-com bubble, companies slapped .com onto their names just to boost their stock price. In the crypto craze, businesses launched blockchain initiatives that were little more than smoke and mirrors. AI is following the same script. Announce an AI initiative, and your valuation gets a short-term bump. Fail to mention it at all, and investors start doubting your future. This herd mentality creates a vicious cycle. The more companies announce AI projects, the riskier it looks not to have one. So billions are poured in, not out of vision, but out of fear. Corporate hypocrisy. Publicly, companies present AI as a way to empower employees and unleash creativity. Privately, the real goal is simple: cut costs. Automation is the dream. Replace call centers with chatbots. Replace marketing teams with AI copywriters. Replace back-office staff with algorithms. Executives sell AI as progress, but to the workforce, it feels like betrayal. When empowerment turns out to mean replacement, employee trust collapses, and customers notice too. They're promised smarter, more personalized service, but often get clunky bots and irrelevant recommendations. What was supposed to enhance loyalty ends up eroding it. The hidden costs. Then there's the financial side. AI isn't cheap. Training large models requires astronomical computing power, cloud infrastructure, and specialized chips. And the talent to run these systems? Scarce and massively expensive. Consulting firms, smelling opportunity, have flooded the market with AI transformation packages. Many of them are selling little more than buzzwords wrapped in slides. Companies spend millions, sometimes billions, only to realize that the promised ROI was a mirage. Projects are quietly scrapped, budgets blown, executives shuffled out. Legal and ethical landmines. AI also comes with legal and ethical risks that most leaders don't want to think about. An AI used in hiring discriminates against women. An AI used in lending systematically rejects certain communities. An AI used in customer service leaks private data. These aren't hypotheticals. They're already happening. And when they do, lawsuits, fines, and public outrage follow. The same executives who once bragged about transformative AI suddenly scramble to explain why their system was biased, why regulators are investigating, or why customers no longer trust them. Dependency and lock-in. There's another danger: dependency. Most companies don't build their own AI. They rent it from giants like Microsoft, Google, or OpenAI. That creates a hidden trap. Once your business is reliant on a vendor's AI, you're locked in. Prices can rise, terms can change, features can disappear, and you have no choice but to pay. It's the cloud computing trap all over again, except this time, the dependency runs deeper. You're not just renting servers, you're outsourcing the intelligence of your business. The existential question. But even if AI delivers what companies want, lower costs, higher efficiency, fewer workers, there's a bigger problem no one wants to face. If AI replaces millions of jobs, who's left to buy the products these companies make? Capitalism depends on a cycle. Companies pay wages, workers spend those wages on goods and services, and the economy keeps spinning. But if AI allows companies to slash their workforce, that cycle breaks. You can build the most efficient factories in the world. You can generate content, design, and customer service at near zero cost. But if millions of people are unemployed or underpaid, demand collapses. What good is cheaper production if no one can afford to consume? This isn't just a theoretical debate, it's an existential risk. Companies obsessed with short-term cost savings may be sawing off the very branch they're sitting on. By eroding their own customer base, they could trigger the collapse of the very markets they rely on. It's the paradox of automation. The more successful it is at replacing humans, the more it undermines the system that makes it profitable. The coming reality check.